In every market trend, there are contrarian traders. In a bull market, these traders try to push the market down. In a bear market, they buy to support the market. But as you probably know, these counter-trend traders are wrong most of the time. Luckily for us, we can capitalize on them to find great trading opportunities. In today's video, I will share a simple scalping and day trading pattern to take advantage of traders betting against the main trend. First, let me explain the psychology behind the setup. Counter-trend traders play a big role in sustaining market trends. For instance, when counter-trend traders short in a bull trend, the market retraces. Then, as the market resumes its way up, these traders realize their mistakes and quickly cover their short positions. Some of them might even reverse into bullish positions. Their reaction helps to push price higher. So instead of pushing the market down, the counter-trend traders helped to sustain the bull trend. So if we intend to find an entry point into a bull trend, we should take advantage of the contrarian traders who shorted the price. The ideal scenario in a bull trend will be many counter-trend traders realizing that they got it wrong when they shorted the market. Then, at approximately the same time, they reverse their short positions, creating immense buying pressure. Now let's think logically. What determines counter-trend traders to exit or reverse their positions? Imagine you are taking a position against the bull trend. You know it's a dangerous trade, but you say to yourself you just want to catch a small move. So you put a narrow stop-loss order close to your entry. In your head, you are already anxious that you trade against the trend, but your immediate expectations is to see the market go down. Now, right after your entry, the price stalls. It doesn't go down as you wanted. And now you're even more anxious. And then comes the regret that you took the trade. And as the price moves up, you take an emotional exit and cover your short position. So, what made you feel anxious? What determined you to close the trade? It was the market stalling right after you took a trade against the market bias. That's the framework, the psychology behind our setup. So how do we find such patterns? In bull trends, counter-trend traders show up as strong bearish bars. These strong bars open near the top of the bar and close near its bottom. In bear trends, we search for strong bullish bars. A strong bullish or bearish bar is one with a body that takes up more than 50% of the bar range. Hence, a strong bullish bar always opens in the lower half of the bar and closes in the upper half. A strong bearish bar opens in the upper half of the bar and closes in its lower half. Most strong bars are obvious. When you have doubts as to whether a bar is a strong one, assume that it's not. And very important, not all strong bars are created equal. A strong bar with a body taking up to 90% of the bar range is a stronger bar compared to one with a body that measures only 50 or 60% of the bar range. Here is the full context for a long setup. First, we need an upward trend, meaning that the market must record higher highs and higher lows. Second, we need to find counter-trend traders, so we need a pullback, meaning a strong bearish bar. That's bar A. Third, the previous strong bearish bar must be followed by a weak bar. This can be bullish or bearish. That's bar B, the setup bar. The point is that we don't want to see any momentum for the downward move. By looking for strong bearish bars that fail immediately, we find the anxious counter-trend traders. 4. We trade in the direction of the upward trend by fading the counter-trend move. Place a buy stop order above the high of the weak setup bar, so the buying area is right above the high of the weak bar, which follows the strong bearish bar, with a stop loss below the low of the weak bar. Practically, we need a third consecutive bar, bar C, to trigger the buy stop order. If bar C doesn't trigger the buy stop order, cancel it. For a short setup, first we need a downward trend, meaning the market must record lower lows and lower highs. Then we need a counter trend move, an upward pullback, meaning a strong bullish bar. That's bar A. Then we need stalling price action, so the previous strong bullish bar must be followed by a weak bar, bullish or bearish. That's bar B, the setup bar. So no momentum for the upward move, as we need a strong bullish bar that fails immediately. We trade in the direction of the downward trend by fading the counter trend move. place a sell stop order below the low of the wick bar. The selling area is right above the low of the wick bar, following the strong bullish bar, with a stop loss above the wick bar. Then we need a third consecutive bar, bar C, to trigger the sell stop order. If bar C doesn't trigger the sell stop order, you cancel it. This is a valid long setup that had the support of a bull trend line and the market bias. The market rose above the trend line by a wide margin with strong momentum, confirming the bullish market bias needed for us to consider bullish setups. A strong bearish bar formed as the market fell towards the bull trend line. The following bar went below the low of the bear trend bar, which is also important. However, it ended with a long lower shadow that showed buying pressure. The bearish counter-trend traders didn't find the bearish follow-through they expected, so the market presented a possible long setup. The market triggered the setup within the next bar. With the clear switch to a bullish market bias and the support of this bull trend line, this setup was a great chance to join a fresh bull run to the upside. Here's a short setup. The market pushed to a new low, displaying good bearish momentum. This bear trend line was intact, showing structural resistance for the bear market, lower lows and lower highs, so the bearish bias was crystal clear. We then have a bullish zone with lower wicks showing buying pressure, pattern which attracted some counter-trend traders. We have a strong bullish bar that followed, confirming that at least some counter-trend traders have entered the market. We have a weak bar right after, which is the setup bar. The market broke the low of the setup bar, confirming our short trade. This example demonstrates the profile of the best setups. The best setups have a clear market bias that is ignored by counter-trend traders, and a decent counter-trend setup that looks tempting to reversal traders. This is very important. If a bullish setup doesn't look good enough to trap traders into a bearish market, its failure wouldn't push the market down. Similarly, if a bearish setup doesn't attract traders to assume short positions, its failure wouldn't lead to an upward move. The pattern is also useful for range trading. Here we have sideways movement, forming a solid trading range. At the bottom of the range, we found two valid swing lows, representing a major support area. As the market fell all the way down to the support, it even punched below the support area of the trading range with a strong bearish bar. However, the next bar was a bullish wick bar. Since it wasn't a strong bearish bar to confirm a breakout, this was a long setup, which was triggered by the following bar. So when you find trade signals, search for setup bars at support and resistance levels. Support and resistance levels are a price action trader's best friend. A quality price action entry signal forms at a key level of support or resistance, being a high probability entry scenario. The key level gives you an extra barrier to place your stop loss, and since it has a strong chance of being a turning point in the market, there's usually a good risk-to-reward ratio formed at such key levels of support and resistance. Here are other examples of valid trades around support or resistance levels. This trading setup is one of the simplest price action patterns. You can add a moving average to the setup or your preferred trading indicator to get an extra confirmation of the quality of the setup. If you find some sort of confluence around your setup bar, that's even better. It's important to understand that each trade and each setup is unique. There will never be two trading situations that are exactly the same in the market. Each trade has to be taken on a case-by-case basis, and it's up to you to decide when and how to pull the trigger on a trade. That's why I insist to take your trades at key levels in the market and avoid blind entries. A blind entry is when you are entering into a trade when you spot a possible setup with no consideration for market context or recent price action. High quality trades must be taken from a key chart level of support or resistance. As always, if you learned something new and found value, leave us a like to show your support, subscribe to our channel, and click the bell icon to stay in touch when we release new videos. Until next time.